Hey guys, welcome back. Now, the next 6 months in the financial markets is turning out to be one great big flip of a coin. On one side, we have ever-increasing rate hikes now at levels not seen since 2008, an inverted yield curve out of control, and many indicators pointing to a recession. And on the other side, we have inflation continuing to fall, crypto having an excellent start to the year, and mega institutions announcing they too want to be part of the next big bull market. Now, as Cathie Wood has just given her latest monthly market update, as always, I'll be covering what I thought to be the 3 biggest takeaways. Why she believes there's still a lot of pain in the market with the next crisis looming. Then, is it possible for inflation to come down to this magic 2% range in just 2 days from now, as she explains how? And then we'll finish up taking a look at how all the major asset classes have performed so far this year, and we'll see the big winners and the losers. Okay, so first up, the big question is there still more pain to come, especially for risk assets, or is the worst now behind us?
But that there is a lot of pain, and we also see that the KRE, which is the regional bank index, is just wallowing around where it was roughly during the regional bank crisis earlier this year. So no real recovery there either. And of course, one of the reasons is the biggest lenders to commercial real estate these days are not the big banks. They're not allowed to allocate that much risk to commercial real estate, but the regional banks. So we believe they are in quite a bit of under some stress. And that will continue if rates continue to move up, because the incentive to move to money market funds or government-backed funds is only going to increase.
So it turns out you can't just raise rates at the fastest pace in history without there being ramifications. She again referenced this commercial real estate time bomb ready to go off, as vacant properties do not mix well with high interest rate payments. And she also referenced KRE, which is made up of the smaller regional banks. And notice after the last crisis, it shows these banks did not recover and still have to absorb another round of rate hikes, meaning more potential issues for the bank's balance sheet and even more money flowing out to money market funds, a double whammy. Now, next up, one of the biggest battles of the last 6 to 12 months, as we all know, has been with inflation. After topping out at 9%, the last print has come down significantly and sits around 4%. So next up, Cathie Wood now explains how this could be in the magic 2% range in just 2 days. How is this possible? Well, take a look.
We do have the CPI. The last print was 0.1% month to month, so very good, well-behaved month to month, but still up 4% on a year-over-year basis. Now, this next month, so for June, and this report I think will be out next week, the comparison against a year ago was month to month, the CPI from May to June a year ago went up 1.2%. So if we see the CPI up only 0.2% this month to month, then we will be dropping off a full percentage point. And that will take the year over year down from 4% to 3%. I know that's maybe a lot to digest right now, but it's the comparison against a very big increase last year that gets us down from 4% on a year-over-year basis, which was reported for May for the CPI, down to 3% in 1 month. And if perchance it's lower than 0.2, then we will be dropping in to the 2% territory, maybe 2.8 or 2.9%.
So, amazingly, inflation could be down to the 2 to 3% range in just 2 days at the next CPI print, coming to a screen near you July 12th. And it makes me think, what would that do for risk assets? However, credit where credit's due, you have to admit the Fed has done a very good job at getting inflation down over the past 6 months. Just wish I could say the same about the government here in the UK. We are still performing as one of the worst in Europe, with Trueflation saying we're at over 11%, with our official number at close to 9%. Sucks to be in the UK right now. Okay, and to finish up, as it feels like we're all still licking our wounds from 2022, emotions aside, how have all the major asset classes performed so far this year?
The Bloomberg Commodity Price Index, it moved up 3% in the month of June, but is still in a downtrend. Should have mentioned the yield curve is still inverted. It got more inverted last month. It got to almost 110 basis points, which is the inversion it reached right before the regional bank crisis. It's come off that a bit here, but we wouldn't be surprised to see if it signaling, more crises, whether they're in the commercial real estate market or in the private equity market in a way that we don't understand right now. Bitcoin, sort of the harbinger for crypto, up 10%, good month. And of course, there is the speculation about a potential approval of a Bitcoin ETF. That got people excited. But the other thing we'd like to...
Now, as Cathie Wood only covered a couple, let me just jump in and fill in the gaps. So let's do a full breakdown of asset class performance year to date. And we'll be looking at commodities, in which we'll be using the Goldman Sachs Commodities Index. Bonds, we have BND, which is the total bond market index. We have gold, we have stocks, we'll have the S&P 500, cash, and crypto, which is the entire crypto market. Now, starting with commodities, and we have a negative 6.5%. Not good for commodities. Bonds, we have negative 1%. Not good for bonds. Gold, the original safe haven asset, up 4%, which is okay. S&P 500 is rocking it at 15%. Now remember, the long-term average for the S&P is around 10%. So the stock market is having an excellent year. Then cash will always be sitting at 0%. Now, before a lot of you start shouting at your computer screen saying no, with inflation, cash is negative. Now, with the last print being at 4% inflation, cash should be negative 4%, right? Well, inflation doesn't just affect cash. It impacts all of them. So you'd have to reduce everything by 4%, in which case commodities is actually negative 10%, really bad. Bonds, negative 5, very bad. Gold is actually keeping up with inflation. Your purchasing power is wiped down to 0. Stocks is still really strong, cash negative 4, and crypto is having a stellar year, up 100%. And I think the big takeaway for me just shows that in the most terrible crashes, it's the people that have the kahunas to buy when things are getting crushed. So the obvious one here is crypto. After the shocking 2022 year, who of you watching was able to purchase at the height of the fear, as you have been rewarded very, very well? So this is 2023 so far this year. The next 6 months for the financial markets is turning out to be a bit of a flip of a coin, with lots of ammunition for the bulls and the bears. Cathie Wood reiterates that there's still pain in the markets. The banks are still in trouble, more rate hikes are probably coming, and the yield curve is still badly inverted. Now, interestingly, with inflation, due to the large increase this time last year, the next CPI print in just 2 days, we could be in the magic 2 to 3% range, and this would be a huge boost for the bulls. And as far as 2023 goes, so far this year, risk assets are back, with crypto leading the way up 100%. Stock market is up 15%, which historically is very strong, and everything else is struggling to keep pace with inflation. So there you are, guys. Hope you enjoyed. Now, let me know your thoughts and comments below, but just remember to address and get rid of 100% of the comment spam and trading bots. We are trying out the new SuperThanks button below. This way, you can get all of your questions and comments read and replied to, or if you have any requests or just want to say thanks, then use the button below. And for now, just to say, if you did enjoy anything in the video, then drop a like, and a big thank you to everyone who does, and I'll see you in the next video. Bye for now.